Rob's question. It's a great question. Takes on different things, and I'm going to offer my opinions, but of course anyone can float their opinions in on this as well. Rob says, what is the best or fastest way to find the best options to trade that have the needed premium and higher IV? Okay, before I point you in the direction, Rob, and go into my commentary on this, fastest way to find the best options trade. First thing is first. There is no such thing, in my opinion, as the best options trade. Okay? You can take a screenshot of the market at any day, look at it 10 days, 5 days, 14 days later, and say, yes, that was the best trade. And it was the first one that came up on your search list, organized by how you decided to sort it in your criteria. And then you take the next cycle and you look at the screenshot and you go 5 days or 10 days or 14 days forward, and the best options trade was actually the one that was listed third. And then you do it again for the next cycle, and the best options trade was the last one that was, the next one was 7th on your list. Okay, so maybe you need to order it differently, but you change the order and the one that comes up on top is not the best trade. What is more important to me personally as an options trader is not the best trade at any given time, and not even necessarily, and hardly ever, the option with the highest IV for selling. Okay? What I do is develop a trading plan for the strategies I trade in my personal account, whether it be covered calls, naked puts, bull put credits, diagonal spreads, calendar spreads, for example, Rob. Married puts, I wouldn't be looking for volatility anyway, but the selling premium, okay? So the short answer is, on the strategies I mentioned, if you're looking for covered calls, whether you want to do monthly or weekly, this is why we've developed the weekly picks of the day. What would I trade on Monday if I was opening a new covered call position? Well, it would come from this list that's been tested for the monthly picks of the day or the weekly. Why is there a difference? Some investors like to trade weekly, some investors like to trade monthly. Now, the full results that match our criteria that Ernie tested are available in the search. But if you just wanted a quick view of the top 2, the covered call positions that Ernie or myself might trade, it would come from the weekly picks of the day list or the monthly picks of the day. Same with the naked put strategy. Okay, if you're looking for selling premium, higher IV, we don't do naked calls personally, Rob. That's one of the situations there. But let me add naked put there. Let's take out this short strangle for now. That was from a conversation on last Friday. You can see here the 23 strategies we support. I'm going to add naked put back in. Click Save Configuration. And under the naked put position, you've got the weekly picks of the day as well. And you see for 5 7-day trades, you're looking at yields of 1.5, 1.5, 1.4. Good premium on the position, relative probability as well. Okay, now you see here the implied volatility is 0.47, 0.4617, 0.43. Are there positions that have a higher implied volatility that might have a higher premium? Absolutely. But through testing, what we found is that those don't work out long-term as a trading plan as well. Okay? Because you suffer too many losses. Something that has a high implied volatility has a high implied volatility for a reason, right? Something's coming up, or something did just come up, or the stock in general, a pharmaceutical, a biotech, has a tendency to fluctuate drastically. That's not something I want to be in a directional trade in. As a naked put, which might give me a 1, 2, or let's say a 3% yield with a higher volatility for a 7-day trade, but has the potential to swing 10% down in a 5-day period. That's a 7% loss. That's not bad. But long term, that trading plan is not successful. The losses tend to outpace the gains very quickly, even though you do have the higher implied volatility and the higher premium. So let's go to the search real quick in naked puts while I'm here. And 3-month out, that was a search we created, one of our other sessions. I'm going to go to the full search for weekly picks of the day, the same criteria. And right now, with the better updated, PG and E came up at the top with a 2.8% yield, only a 40-cent out of the money position for the naked put. Implied volatility is higher, it's at 0.68. Now, for me, even though it's at the top of the list, I don't know if I would do this particular trade. It's a little bit too close to the money, even for a 7 to 5 day trade. It has a great yield. But let's take a look at that chart. And we're going to take a look at big charts, and this is a 3-month chart, and it's been holding above 20 in the past half month, but notice how it just had a negative MACD crossover down here, and it just broke below the 20-day moving average, though it's trying to come back up. And it has been trading below the 20 range. Not to 19, not to 17, but not looking like a promising chart, even though it has the highest implied volatility and the best return. I don't know if I'm comfortable with this one. Maybe a 19 strike if it's available. Maybe not, because I still don't like the chart. Okay, but you see the other ones that were in there in our other search that came up, just the default link. So typically, the testing was every Monday at around 3:30 or so, I'd look at the top two here and make that trade. Bull put credit spreads, the bull put weekly search, it's not a picks of the day field. But when I go to the bull put picks of the day, weekly bull puts, excuse me, these are the top ones I'd look for. So on Monday, I'm opening these higher positions, 16, 15% return, but it's a 2-week out span. That's the trading plan we found. The criteria listed below are the criteria that we found work best long-term in different markets to achieve that 85, 88, close to 90% success rate depending on the markets. So from January 1st to April, the success rate was 89%, and the return was 12% if you opened a bull put credit spread every 2 weeks, or you opened the top 2 or top 3 every 2 weeks. But these aren't the highest implied volatility, because when we tried to increase the implied volatility to look for a better return, you're at 0.47, 0.29, 0.32, and so forth. But when we looked for the higher implied volatility, you had a lower success rate because of fluctuations, directional trade. We don't want the stock to fluctuate. We want something that matches our target return with our expected probability to have a long-term successful trading plan, as opposed to looking for the position that offers the highest implied volatility and the highest premium. Okay? Because the goal is long-term performance and a win-loss ratio that matches the structure that you're in and the trade that you're in. Okay, so for bull puts, I need that 80, 83, 85, 88% success rate on positions that have a 9-to-1 risk-reward ratio. And you say, oh, why don't you just go less out of the money and look for 20 to 25% returns, higher net credits with only a 65 or 70% probability, because we tested that. And long term, it actually loses money. Where going and taking the 9-to-1 risk-reward ratio actually makes money having the right success rate. And the right success rate is not just about looking for the right net credit, looking for the right probability. You also have to factor in the stock criteria as well. I need to look for stocks that match the direction of the strategy I'm trading. I want a stock in an uptrend. I want a stock that avoids earnings between now and expiration for these selling strategies, especially short strangles where you have a naked call and a naked put. I also want other factors in there as well, maybe a good earnings per share growth, other technicals such as the MACD. That all is important. It's not just about any bull put spread with a probability of 85% or higher should have an 85% success rate. That's not how it works. The stock still has to match your trend, still has to have good quality fundamentals. Essentially, you only want to trade a bull put on a stock you wouldn't mind owning that has the same criteria of a stock that you would buy for potential long-term growth. That's what you're looking for when you're doing a bull put, not just the highest return. Looking for the highest return and the highest implied volatility to get the best bang for your buck usually results in quick losses and unacceptable portfolio returns. All of that being said, if you wanted to look for the option with the best premium for selling, whether it be a credit spread, and keep in mind with a credit spread, if you're looking for an overvalued, high implied volatility option for the sell, guess what? Your long option that has the same expiration date on the same stock but is a different strike will also be overvalued and also have a high implied volatility. It's a trade-off, okay? But for naked positions, naked puts, for example, let's go back to the search. And we're talking about the highest premium. We're not talking about the highest monetary premium. That would be a naked put that's deep in the money, right? Has the most intrinsic value as well as some time value. That's going to be the highest premium. That's not what we're looking for. What we're more focused on, if you want the highest, is you're looking for the highest time value percentage, or the naked yield, because it doesn't naked yield takes into account intrinsic and just the time value against the cost. But the time value is really what you're looking for. But again, what is the structure of a naked put? I'm selling a put option that obligates me to potentially buy shares of stock at the strike price if the stock falls below that price. The stock stays above, put expires worthless, we keep the premium. Okay? So with this structure here, you want to be slightly out of the money. Right? You want to have a stock, you want to enter a position where the stock can stay the same, move up as you're expecting, or fall. And you still might make the maximum profit if the stock stays above the strike, it expires worthless. It's a parity trade to slightly in the money covered calls, a slightly out of the money naked put. All right, now, but you want to look for positions, let's say in the next 10 to 15 days that offer the highest premium. Let me clear the filters. We're going to empty everything out. For right now, we're going to look for standard May expiration. If you wanted to look next week, you could just set all expirations, and as we saw before, go 0 to 8 days out in time. But we're just going to look at 2 weeks out, standard May expiration, the 15th. I want a highest time value. What's probably an average time value across all options right now, calls and puts, for a 14-day period? It's probably less than 2%. So we're only going to look for the positions that have a greater than 3% time premium. But remember the structure. I want something that's at least out of the money. Maybe by a full strike, or maybe just by 0.5%. We'll start there, 0.5% out of the money or more. And you could look for a delta too. You know, if you wanted to only look for naked puts with a delta of, say, less than 0.4, we could put that in. I'm going to use the probability instead. And I'm going to set the probability above. Well, oh, I'm in long put, aren't I? Am I in long put? No, I'm in naked put. Okay. So you might still set that probability at about 65, 70% or so as well. Okay, so let's just go 70. All right, now, I could look specifically for higher implied volatility, but with this search, I can tell you right now I don't need to. The return, the time value percentage, being out of the money, that's going to show me only high implied volatility. And this percent implied volatility range, though, this is where the option's implied volatility is now compared to where it has been over the life of the option. Let's put 80% or higher. So if the implied volatility collapses, maybe my option premium decreases, I can buy it back more cheaply. Now, just with that alone, let's run the search and see what we get. All right, not initially what I thought I'd see in the top page. I expected to see 2 times and 3 times ETFs dominating the top of the list. Oh, sorry. Something else we should put in, of course. Got to make the premium make sense, right? That's part of the trading plan. So let's make that at least 20 cents for a 14-day trade. And I want to see some open interest and option volume today. There we go. That's better. All right. Fossils in there. 50 cents for a 12-strike option, 4.6% return for 14 days. Where's my implied volatility? Let's scroll over here. Look at these, 1.45, 1.15. So I just created a search for you that's dominated by implied volatilities that are double to triple what we were looking at in the picks of the day, which has a proven track record of performance. Now, these are normal looking stocks: Hertz, Ubiquity Networks, Yelp, Trade Desk, Overstock, Fossil, and so Therapeutics is in there too. We expect that. Okay, we know these names. They're quality stocks. Why is the implied volatility so high? Again, a naked put is a directional trade just like a covered call or bull put. I don't want something that could potentially fall 10, 12, 15% from an upcoming event that I can't gauge based on stock charts or more. So if I check this box for earnings date, not between now and expiration, there's only two therapeutic companies, biotech stocks, what I expected to see. Okay, and what did we do? Higher time value. So looking at a naked call, which I don't trade personally, but if you're looking at a covered call, naked put, even a short strangle, you're looking at the highest time value. That's what your gauge is. You want something in the upper percentiles of its implied volatility range. The credit has to make sense. You still want a good probability of expiring worthless. I could drop that down to 60 and we'd see other trades with higher returns. But again, trading plan long term, it's not a good idea. All right, very quick to continue this conversation. Let's take back our earnings date between now and expiration. Let's submit this search. There's our high implied volatility search. As we mentioned, we saw everything here: 1.45, 1.15, 1.3, that equates to 130% volatility, implied volatility. Okay, now I'm going to save this search. We're going to call it high IV, naked puts, 14 days out. I'm going to change this actually. I'm going to change. Now I'll save it for now just to see what's going to happen. Now, now that I've saved this search, one thing that anyone on a trial has access to, and subscribers, you can go to the upper level, the historical tools to have this. I'm going to go to the backtest tool. We're going to look at the Smart History Excel. This allows us to run any of our saved search or any of the PowerOptions default screens based on a date back in time. Well, yes, we're doing naked puts. I'm going to go back to March 18th, day after March expiration, day after St. Patrick's Day, and we're going to run our high IV naked put screen. Okay, let's go ahead and submit that. And remember, this is without that earnings date checked. Okay, so nothing comes up here. No positions were found. Let's go to April. The likelihood is we might not have seen as high a time value as we were looking for because we hadn't fully jumped into the earnings yet. So let's go to April. Let's try April 1st. There we go. And we've got Signet Jewelers. Where's our IV? Okay, these are on the 0.9s and 1s. Signet, Bed Bath & Beyond, GameStop, Avaya Holdings. That's what would have matched our search on April 1st with the high implied volatility naked put screen. Let's look at the returns for 14 days, 17 days, 4.9, 4.3, 3.7, double to triple what we'd expect for a normal, good, out-of-the-money naked put for a 17-day trade. I'm thinking 1.5, 1.4% yield. All right, let's calculate group results. So what this is going to do now is show me how these results returned. 40% success rate. Average return is a loss of 1.3%. Lost 5. This is not fair though, because we have two Signet Jewelers. So let me remove. I'm even going to be nice. I'm going to remove the bigger loss Signet Jeweler, the 25 strike when the stock was at 28.05. You probably would have taken that because it had the higher premium. But I'm going to remove that one. So now you're at a 50% success rate with a loss of 0.2%. That was on April 1st. Okay. On the top 5 trades, and we even removed one of them. So you take a 5.4 loss on GameStop, 2.9 on Signet, using the lower out of the money, but you might have looked for the higher return. You did get 4% on BBY. you did get 3.3% on Avaya, but the expected was 3.7 and 4.3. You actually had to buy these back because the stock, I was just looking at the ask price. They both would have expired worthless, so that's good. Okay, but you end up at a 50% win ratio in this case. I know I'm looking at a snapshot, but again, that's what can happen because finding those high implied volatility, double the yields, are likely because these positions had earnings between now and expiration date. Now, let's go to April 1st again, and I'll take the weekly picks of the day. Slightly different expiration, but let's just see how these performed over time. It was a shorter trade instead of 14 days. It was 1 day out. Oh. Let's try this again. 1 second. We're going to come back to this, all right? There's two things happening right now. Number one, all of the history is uploading into the background database for us. So it might be having problems accessing that. The programmer might actually be doing an update to the history recording, and it's not allowing me to get in. And that's probably more important. But we'll come back to this. I'm going to try it one more time, but we'll come back to this later in the webinar to see if we can get those results. I might even try to text the programmer right now and tell him stop fiddling with my webinar. All right. I'm not going to guarantee that this first cycle, or even if I did the monthly picks of the day, let's see what those come up with, that they would have performed better than those other ones. Let's go to standard April. I can change this on the fly here. There we go. This is what I want. Okay, so I'm going to try it one more time. Notice the returns. Where are they? 1.1, 1.7 for the same 17 days expiration from April 1st. Okay, so I'm going to come back to this. I'm going to leave this here. We're going to rerun the search later. I'm going to come back to it when I know the history is available. But I did show you a search that you could create to find the highest implied volatility, Rob. But again, I'm going to mention the fastest way to find trades that have success long-term for selling. Check out the monthly and weekly picks of the day for covered call. One click, you see the trades that likely Ernie and I would be opening for your opening trades in that strategy. Same with the naked put. The way the testing worked is at about 3 o'clock, 3:30 in the afternoon on Monday. The top two trades are the ones we would have opened, and just for the ending cycle. And then, of course, the bull put credit in the standard search. It's not a picks of the day, but the weekly bull puts are the ones I would use to open a new position. Okay, so you can create your own to look for it. I am going to come back to that. I've set myself a reminder here. We are going to come back to that to see where we stand as well. Okay, so I can get those results for you to compare. But you had a 50-50 win-loss ratio from April 1st. I know it's just a quick snapshot, but that's all the time we have to go through today without further backtesting. And it was a loss of 0.2, I believe, or 0.3%. Okay? All right. So I'm going all the way down here to the bottom to see if any comments came in. Okay. Related to this, Sam does mention that ISCC and ENPH is mind-boggling the way they're going up and down in the market the other day. Those are higher volatility positions. He talks about trading. Okay, and that worked for him. Doug, I see your question. I'm just going to go through some of these other comments here as well. UBNT is another one with a high volatility. Okay, sorry, 1 second, folks. Let me get through this. Tandem came up in those searches. It was very volatile around the earnings, Sam comments. That's one of his. Okay, so all right, let's get to Doug. I'm sorry, Doug. Okay, so Doug says, and we'll come back to our results there, but we're on spread trades here. What Doug says, when entering spread trades where the dealer doesn't offer both legs trading at one time, what is the best way to get into the two legs of the spread? I have lost my profit as I was not able to buy both legs at the same time. Any tricks getting both legs filled to maximize profit? Okay, so let's say that I am interested in this Shopify position. Now the midpoint net credit shows up at 35 cents for a 2-point spread, 2.5-point spread, excuse me. And that's a 16.3% return at midpoint. What looks weird here is that the natural bid is 165 and the ask is 160. Let's take this to the profit and loss chart. Okay, what I wanted to do here is when I look at the profit and loss chart, Doug, I see the bid at 165 and ask of 195. My target's going to be 180 is the midpoint. And here, 130 to 160, 30-cent bid-ask spread, target of 145. So my total net credit, if I got the midpoint in this position for that 16% return, 16.3% return, is a target of 35 cents. So when I enter this trade, if I try to enter this Shopify Bull Put credit spread with my broker, I'm going to put in the order, buy to open and sell to open, okay, at a minimum net credit limit order of 35 cents. I'm not going to necessarily put in what I want for the buy and for the sell. I'm just going to put in a limit for the total net credit at 35 cents, and then I'm going to select the choice that you usually have as all or none, okay? I don't want to get filled on the naked put and not the buy, and because I put it as a limit order for a credit, it wouldn't fill unless that credit was able to be received between filling both options. I don't want to try to sell this put at 180 and then put in another order, of course, to buy this at 145, because if this fills and this doesn't, well, I've got a naked put. My broker's going to want me to put up $23,750 for one contract. I don't want that. I want $250 for one contract with a 2.5-point spread. That's what I want. Okay? So I'm going to put in an additional contingent, so all or nothing. Not necessarily fill or kill. Fill or kill, if it's not filled right away, the order is usually canceled. Some of them will do fill or kill to the end of the trading day. You might have that option. Some of them do it within a 5-minute period. That means I have to go back in and manage it. So Doug, I'm going to put in this trade, and I'm going to put the midpoint at 35 cents. And these two orders are not going to get filled unless both legs are filled to where I can get that 35-cent minimum net credit. Now, 10 minutes, 15 minutes later, after getting a phone call, signing someone up for a subscription or something along those lines, I come back and I say, hey, wait a minute, this isn't filled. Well, also on this tool, before I went to place my trade, I would have done something to verify it. What do I mean by verify it? I would have said, well, what if I take 5 cents lower on one range or the other, and I only get 30 cents? Remember, I was taking the highest one there, it was at 16.3%, 13.6% return. Still within the upper 5 trades. So rather than move on to the next trade, my order's not filled, maybe 15 to 20 minutes, I'll lower the expected, and I'll ask for a net credit of 30 cents instead of 35. Still getting the target I want for the 14 to 17 day trade. If that fills, fantastic. I'm still happy with it. Would have loved 35, still comfortable with 30 because of it's still in the top 4 of the trades I would have made from this list of return-wise. I wanted 16.3. Hey, I didn't get it. I'll take the 13.6. Still above my trading plan goals. Okay? Now, what happens if that doesn't fill? Well, at this point, I realize the market maker's not giving me what I want. Check it just to see what it would be if I did another 5 cents. This will probably put us in the 11% range, 11% range, yeah, 11.1. Still preferred. Still matches my trading plan. However, I might be better off now just leaving this one because the market maker's not getting what I want, and do the other top 2, top 3 trades that are listed in the search that match my total criteria. Okay. All right, so that's what I would look to do in this situation if you're not filled. Sam says that his bull puts he usually puts in. I put in 2 legs. Okay, I personally don't do that. I put it in as a credit. And as a joint order. Number 1, Sam, it saves me commissions. Number 2, I don't want to accidentally get filled on the naked put, as I mentioned, and have to put that margin up if the long put does not fill. Okay. All right. Let me see here. Sam, you did have some other comments. I'm going to get to those there. And following up on that, what you mentioned, which goes back to what Rob was talking about earlier, is that your tandem there, the higher implied volatility options, I should have pointed this out, but the higher implied volatility options, such as those therapeutics, biotechs, tandem, TNDM that Sam mentioned, they tend to have a wider bid-ask spread. So getting filled at the midpoint is less of a given. Okay, Sam even says he doesn't always get filled. He's talking about Ruby, I believe TAIT, Zixi, you said you had 100% on the calls return there, but it's harder to get filled at the midpoint on a consistent basis because it's a wider bid-ask spread. Yeah, Sam doesn't need to worry about commissions. That's what he's mentioning because he trades on Robinhood. So he doesn't have to worry about the commissions on the two legs. Yeah, I'm currently not using that, but again, I don't want to get stuck with a naked put, even though I'm bullish on the position and the bull put and the naked put. I want the same direction. But, again, that's kind of what it comes down to there is the fact that I don't want to put up the margin for the naked put if it just gets filled. I'll put in my order as a total spread and put in a limit net credit so it won't get filled unless that net credit is achieved. I will lower the net credit if it's not filled, but if it goes too low, I'm just going to look for the next position that was on that list that matches my criteria in the spread. We might not even be talking about bull puts here for this particular question. We might be talking more along the lines of a debit spread or a diagonal spread or maybe even a long strangle. Still, I put the orders in together for both legs. I put in my limit net debit or limit net credit. If it doesn't get filled 15 to 20 minutes, I might adjust it based on where it's still acceptable for my trading plan for that strategy in my portfolio. If that's not met, I'm not getting it. The market's not doing what I want. The market maker's not giving me what I want. I might just move on to the next trade, revisit this one in a day or two to see if I can still get that 14, 15, 16% return I wanted. Okay. John asks a great question as well. And this is related to something I do in my portfolio. And this is related to something that, of course, I teach. I practice what I teach, and I encourage others to take advantage of it. And that's related to the radioactive trading concepts, the limited risk married put strategy, which forces investors not only to limit risk to a controlled 4, 5, or 6% on any position, with the proper structure of a stock plus long-term put combination as taught in the blueprint. But it forces investors to control risk not only because of the structure, but because it does involve buying stock and buying the put option. So it's capital intensive, but by controlling the risk, even if you're right only 50% of the time, you can even profit. If I'm only losing an average of 4% on my losers without even doing the 12 different adjustments or income methods we discuss here in the blueprint, and because I left the upside open, unlike a covered call or naked put, I'm averaging 6% or even 5%. I could be wrong slightly more often than right and still make money. It's the only strategy I know where you can do that. Or properly structured collars, but you don't get a lot of win-loss ratio. But in any case, John's question is that, is there a downside to an all married put portfolio? The first things first, let me go back one more step, John. You've heard me many times in webinars say that my allocation to my options trades in my portfolio is roughly about 50% into the limited risk married put positions. About 15 to 20% are in the bull put spreads, typically just using the bull put weekly screens to open positions every 2 weeks. Another maybe 10% or so, 15% will be in diagonal spreads, diagonal collars. And I might actually use another 5 to 10% or so on straddles or strangles or round earnings. This is for income. This is for income, but a little bit longer term. The I really should say 5%. 5% on earning straddles are gambles, lottery tickets. Not looking to try to track one stock and buy a call here, sell a put there, and then buy a call, buy another put if it starts to decline, roll down the call, and then as it starts to recover, sell that call. I don't follow one stock. I follow strategies. It's different. The comments you've seen by Sam that I've just been going over very briefly, he has other comments we'll get to towards the end of the presentation. He tracks specific stocks over time and does very well timing the positions with managing let's say a long strangle with a long call and a long put, maybe selling a put against it, but when the market turns, he buys back that put, sells the call, and maybe adjusts the long and the short. And he'll trade that same stock in that fashion for a few weeks to a month in time until the chart starts to go wonky or until he's hit his target goals for that position. Okay, so the comments that you hear Sam offer to us freely during these webinars is what essentially he's doing on a particular stock, one direction or the other. Now, I don't particularly do that, okay? And that's okay. Because the reason why is I don't have the time to watch the screens with doing webinars, coaching sessions, other presentations, and so forth. I don't watch my trades that often. This allows me to not have to watch these trades every minute of every day or spend 30 minutes a day even looking at them. I'm not as active as a trader as most of you probably. And that's one advantage of the married puts. Okay. Binh does offer a comment. And Binh's comment to yours, John, is that as long as one keeps rolling the put, meaning that as the stock moves up, you follow the income methods for the adjustments, and then when you get within 60 to 50 days to expiration of the original put, if you held it that long, to move it out again so you don't lose all that time decay. Okay? But what is the advantage of an all married put portfolio? Well, the advantage of an all married put portfolio is you don't really have to watch it that often, number one. Number two, you know that there is nothing that can go wrong where any position in your portfolio would have greater than a 5 to 6% risk. Even if the stock went bankrupt, even if it fell 40% overnight from some unexpected news, your maximum loss in the worst case scenario is 4 to 6%. And to start, you've left your upside open. Now you hedged with the put. So if in a 2-month period the stock gains 10%, you're probably looking at only a 6 or 7% gain. All right, that time value you paid for the put is going to counter that gain. So what are the advantages of it? Well, you're structured perfectly. You've got the proper position size almost forced upon you in every position in your portfolio if you're in all married puts. You've got unlimited upside potential gain for a nice run that we've seen from January until now, with some hiccups there, but essentially January to now, all of 2017. The first month of 2018 before the February and March little corrections, and essentially from June to September of last year. You can just let those run and then adjust the puts when you get to expiration. What is the downfall? Well, you're not generating income and necessarily realizing premium, right? You're not taking in premium necessarily on a monthly basis if the stock's taking too long to move up to a strike price that makes sense to sell. You may feel that your portfolio is doing what you want if you've picked the stocks that are moving up, and when you see something drop, you might just want to cut anchor. You won't hit that 5% loss in the first 60 to 70 days if the stock moves down. You might only lose 2 or 3% because you haven't lost the full time value on the married put. That's another benefit. But if you start to see one that's going against you and not meeting expectations, cut it out of your portfolio and just move on to a new one. Disadvantages is slow growth, but steady with limited risk. And eventually you may be able to bulletproof all of the positions to where you have no risk on most of them. That is potential in what we've seen from January till now with the broad market. Disadvantage, how active do you want to be? I don't want to spend all day watching my portfolio. I don't want to spend all day trying to gauge at the right time to close this or sell this based on implied volatility, movement on the stock. Hey, I sold this option and it's gained 10%. It's gained 20%. I can buy it back for 20% cheaper. Let me do that and roll down another strike for more safety. But you also probably just don't want to sit there for a month and a half, 2 months at a time and do nothing. if you did that, if you wanted to do that, you might just be investing in a mutual fund, for example, or something along those lines. So the disadvantage is it might be more slow going for you. It might be very slow moving. I don't want to say watching paint dry, but it might do that. Now, yes, you probably have a goal to apply the income methods to sell premium against it, and that's good. That takes care of that watching the paint dry aspect. But depending on the stocks you select, it might be slower moving. It might be slower going, but a full portfolio of married put positions is not a bad idea, especially if you feel, especially if you have stocks right now, John, that have an unrealized gain, and you want to lock in the profit now if you're expecting a market turn rather than sell the stock and get out of the position. Add the put to it now, create it as a married put, and you've got time on your side. And if the market does correct, you've locked in 80 to 90% of your expected gain as well. On that topic, John says you'd like to discuss it with me. John, that's great. You can send me an email this weekend. I don't know how much I'm going to be able to check email this weekend. Actually, I've got a lot of things going on. But you can schedule a session for next week. We can talk about it further. Fernando says, can you make a back test of a married put search to simulate 100% married put portfolio? Yes, but not during this webinar. We won't have the time. I've already got some of that done, as I mentioned a couple weeks ago, maybe even last week. I can't remember when I mentioned it, but when we talk about the married puts in our search criteria that we use, what I use for the married put screens, here we go. I had mentioned that pretty much every 6 months or so, I take this search criteria and I go back in time. And I say, okay, 4 months ago, if I had run this criteria, oh, sorry, folks, let me get rid of that. I'll come back to that. I'm sorry, but I'll run the search and I'll take out the preferred list we use and change it to the S&P 5-star, one of the value line lists we have in this drop-down menu, right? The S&P 5-star list, NASDAQ 100, for example, S&P 100, maybe S&P Platinum, value line, and so forth. Why? Because if over a 3-cycle testing period with no income methods, if any of those lists outperform what we're using as our preferred stock list, I'd have a discussion with Ernie and we might change it. However, that has not happened in 3 years. This list that we're using is actually outperforming the same criteria structure we would use against the S&P 5-star, against the NASDAQ 100, against the value line list. And value line lists are pretty good, actually. They're even to it, but not something that's better. And those actually tend to have a lower volatility, so the premium's harder to get on some of those value line stocks. Excuse me. So I can do that for you, and I think we could even take a look right now, but I'm not going to be able to do it, Fernando, in the webinar. Don't have the time. So let's go here. I'm sorry. Let's go back to the portfolio. And I saw it. Oh, this isn't it, is it? Okay, this isn't the one. It's on my actual trading account, Fernando, where I have, or my other PowerOptions account. This is just the webinar portfolio here. In that sense, I'm sorry, folks. So I do have one that I look at where at the beginning of this year, was it this year? No, it was October. It was at October and then again at the beginning of this year where I opened 4 or 5 married puts that matched the criteria against our preferred list, against the S&P list, against the NASDAQ list, and against the value line list. And I just let them go for 3 months without doing any income methods. And in all 3 cases, or all 2 cases, the IBD outperformed. Value line was a close second. It was almost a tie, especially from January to March, I think it was, March expiration, the 17th, 15th, excuse me. But I have that somewhere. It's just in that other account as well. And I don't want to log out of this account yet because I want to go back for Rob real quick. I'm going to see if we can calculate our group results. Remember, we had a discussion with Rob about creating a high IV search with the best returns for selling options. We created one with a naked put. We named it high IV. We ran the top 5 results, and it ended up with only a 50-50 win-loss ratio. We took out 1 because there were 2 signets that came up, and it was a loss of minus 0.2%. Okay, so that was with the high implied volatility search. What I wanted to do then is run our picks of the day screen for 14 days out to match the same time frame we looked on the high IV search and compare the results. He had a couple of errors, and it's still there. Okay, so let me do this one more time. I apologize. Just going to do something quick here. Sorry. I'm one of these people that can multitask and can answer a lot of questions about web options trading and everything on the fly while doing my presentations, having coaching sessions, and more. What I can't do is text someone and type at the same time. Text someone and talk at the same time. Okay, so I just retexted the programmers and asked them if this will be fixed by 6 so that we can show that for Rob to get this, see if we can get the group results to calculate. And if we don't, then I'll just do this later. Speaking of which, I'm going to print the screen real quick, and I'm going to make sure I have the right criteria. It's already saved, of course, but I'm going to make sure we have the right results there when we run that comparison. I'll send that to everyone as well. Okay, now, stepping back. Okay. All right. Okay, good. So that was John's question we just covered, and I've got some comments on that I'm going to address right now. Okay, sorry about that. There we go. Okay. Paul made a comment. He said, I had success with married puts with expirations of approximately 30 days for situations when I expect a stock to move in the next month or not to move. Would you still use expirations, say 6 to 9 months, even in those cases? Yes, I would. And it's only because, Paul, that if it doesn't move the direction I want, and you might have only taken a 4% risk. I understand what you're saying. So if you opened a 30-day out married put, you still might have the same 4% risk. If the stock doesn't do what you want in those first 30 days, you might take the 4% loss. And if it did go up 10%, you might actually have an 8% return because you paid less for the shorter term put. Okay, so that's Sam's thought, or Paul's thoughts. Excuse me, Paul. But then he asked me, would you still say 6 to 9 months even in those cases? I personally would, because I've played diagonals and I've played the what we call the dynamic collars, Paul, you and I, the calendar collars, with maybe going a month or 2 out on the put and selling a weekly short-term call against it, and hoping for a reasonable return in that case. And I've still felt that my married put portfolio, as I trade it following the radioactive trading techniques, has outperformed long-term. We can look at snapshots and say, in January to March, the bull puts greatly outperformed my bull puts outperformed my married puts. And you'd say, well, why wouldn't you just do that with 50% of your account? Because at the end of the last year, from October to December, the bull puts took almost a 40% hit. And so wild fluctuations. Long term, they're still very profitable for me. Long term, they're not as profitable as going 6 to 9 months out with the married put position. And I haven't been as successful as using shorter term. My statement to you, Paul, though, let's get off of this and go to the married puts, though. My statement on that to you, Paul, is not a fair statement, because anytime I look for a married put and I open a married put, it's because I have the expectation that the stock will move up 3 to 6% in the first 20 to 40 days. Right. Last year, I was right about 80% of the time with that notion. But then it's also because in the following months, I expect it to gain another 5 to 6% possibly. So over an 8-month period, I'm looking for stocks I feel will gain 12%. You're talking about looking for a position that's bullish on a 30-day period for maybe a gain of 4, 5, or 6%. And although I'm looking for that off the draw, what I'm looking for is benefit of longer term of continued growth after potentially bulletproofing or cutting the risk by more than half. So my statement that the married puts I use outperformed the married puts and standard collars, with that shorter time frame protection that you had mentioned. Me saying that the married puts have worked better is because of the stocks I was looking for, because I'm looking for stocks that match the goals of the 6 to 9 month structure, not doing a comparison of if I had just done the puts 30 days out and closed the position in 30 days of the position I opened, would I have outperformed what I did with the married puts? And I don't think I would have. And again, as a comment to you, let's go back to our chart here. Let's just take SPY. Okay, this is a 3-month chart I'm essentially looking at, so it's about going back to January. Well, it's not. Let's go 5-6 month chart. Sorry, we could see it there. Okay, so with the exception of one, most of my married puts were successful. But again, positions that I opened in this time frame have puts that are out to July, October, maybe further. Okay. Looking at this chart from January to February, even into March, now going into we cut it here at the end of April. I'd probably say that if you just bought 3 1-month out married put positions with a 4 to 5% risk, and you entered them here, and they closed at January expiration, then closed at February, then closed at March expiration roughly, and then closed at April expiration, you're probably outperforming what I'm doing in the married put, my married puts right now. Be honest, just looking at the chart, I can probably say that with a guarantee. Okay, regardless of the stocks you picked, you'd have some losers in there as I did. You'd have some winners in there as I did as well. My winners are muted because of the longer term put. You're taking the profits quickly, paying less, and getting out of the positions. But on an overall trend of the market, this is 2 years now, so let's just take from last year, right? Starting in 2018 to the decline, oh, it's so brutal, but yeah, to the decline in December, I'm going to say that my long-term puts would have outperformed the short-term monthly married puts over this 12-month period. And we probably would have been even during 2017, and you're performing better now. That's my guess. I don't have the statistics, but just looking at the charts, you would have taken full losses here. I wasn't. I was only at half loss. You might have taken full losses here. I wasn't, even if I closed, and I'm still in the position. So as it recovers, I've got the lower cost basis, can bulletproof these trades, can do income methods here. Oh, the market falls again, but guess what? All of mine had no risk. You are getting profits here in that 5-month period, and then losses, max losses, max losses. So that goes back to what we were talking about with Rob with the trading plan, is that depending on what you're looking at going forward, what works best on a longer time horizon for consistent growth. And as I mentioned, you're probably 2 to 3 times higher than me on the return on my married puts if you had just done 1 month over this 3-month period, 4.5-month period, 4-month period. Yeah, you're probably 2 to 3 times my return with using 30-day out, slightly out of the money puts with less cost and taking the profit. And not all the stocks moved up, but I'm factoring in, hey, the ones that fell, yeah, you might have taken a 4% loss on 2 or 3 of them. 20%, I'm sorry, 20%, 10, 20% of them. But again, just because of the shorter term burst, I think you'd be more profitable in the last 3 months with that strategy. Okay. All right. And following up this, Mark says, I may have missed this on married puts. What is the range of total risk that is contemplated when setting up the total cost, strike price, and intended risk? And you say 5 to 10%. My average is probably about 6.5% risk. I'll open any position below a risk. This is me personally. I'll open any risk that I like the stock on with a risk below 8%. So this one might be acceptable for me. These are fine. I stay away from the 8%. This one is similar to one that I've opened recently. Monster Beverage 6.8%. The default search by radioactive mark here on PowerOptions is the range we look for. It's set to be between 3.5 to 9. As I mentioned, I typically go at about 3.5 to 8.1. And then if I really like one that's at that 8% or 7.9% range, I'm going to try to finagle maybe a little bid-ask spread to get this down to 7.5. My preferred range is about between 5 to 7.5%. Why not 2%? Because there is such a thing as too little risk. You take on too little risk, you hedge yourself out of the position. I mentioned the 7.9% married put. Let's take a look at the search by symbol tool very quickly here. All right, so that 65 with an ask price of 1160 is 7.9%. If I go to the 75 strike, Acacia's at 59. If I go to the 75, it's 3.2. I take this to all results. I can get it down to 1.2 by going to the 85 strike. That's too hedged. Okay, the delta is 0.8. I probably need this stock to go close to 70 before I start seeing any real meaningful profit on the position, right? Because I'm almost completely hedged out. So that's why the target range is always right about in here. The 60 is too much for me, way too much. 65 looks good. The 70 is acceptable if I'm really bullish. That's 11 points away. So if I'm really bullish, though, out to January on Acacia, that's not a bad one to take. My eyes would be drawn to right here. Not too hot, not too cold, not too hedged, not too risky. Right in the middle at 7.9%, but there it is. It's a bid of 1080, an ask of 1160. If I get closer to 1120, I'm at 7.4%. Quite happy with that as well. Okay, let me turn that off so it's not blinking. Answering the programmer. Okay. All right. So that's my answer to you there, Mark. It's 5 to 10% is close to it, but again, it's my preferred range is about 5 to 7.5% on those positions. Okay. All right. Going back, Sam says in the comment, what I'm doing in the market is up. So he's buying calls in SPY at the open, and at 3 p.m. he'll sell 2 strikes higher and make a debit spread to get extra income. Okay, that's just another way. I didn't check this out. Binh says he was lucky. He's in a married put on BABA, long-term married put on BABA. He was lucky not to sell a covered call against it as a gap today. Yeah, I never try to do selling the call. Income method number 1. Yeah, 482, not too bad. Not still 2.5 movement, and wasn't related to earnings. No, it wasn't related to earnings. Let's take a look at that chart real quick while we're here. Yeah, nice little move. Oh, it's nice, steady there. I see what you mean. Yeah, it's always tempting to sell the 190 when you see this kind of chart of the last 30 days and the last 60 days. That 185, 190 look good, but here we've got the bounce today. So now the 200, maybe 205, maybe even the 210 might be looking pretty good today as well, Ben. That's pretty good. Absolutely. All right, so there we go. All right. I'll just go through some of the comments here. Okay, Sam had some comments about bull put spreads on Apple, and I'm sorry, not Apple, it was Facebook, and a couple other positions as well. Good. Okay. All right. So, a question came in related to another comment. I'm still working on that search there, folks. So let me get back to it real quick. I had cleaned off of it. I didn't mean to. Let's go back to the naked put back test. Go to Smart History. And this is following up to Rob's comment. On April 1st, we're going to run the weekly picks of the day, which is usually on a 5-day out trade. And our high implied volatility screen, that high implied volatility screen we created was looking 17 days out. So I'm going to change this, keep the same criteria for the weekly picks of the day, but just change it to standard April expiration, which was 16 days away. I've got the screenshot though, but I want to see the results here. Programmer hasn't told me it's fixed, but they're looking at it right now. can't tell if these are the same ones or not. That's interesting. Hold on 1 second here. It's still showing the screen? Yeah, good. Okay. Let me need to check something real quick here. Oh, that's a reminder too. I got to do that before Monday. I'm pasting in my screenshot. No, these aren't the right ones. April 1st, sorted by percent naked yield. Okay. Did I do the wrong search? I'm sorry, give me 1 second here. I think I changed it to the monthly. That's my guess. But that's okay. Let's try this one. So this is the weekly bull put search extended 2 weeks out for standard April expiration to match Rob's question about the high implied volatility in the comparison. That came out to when we removed the extra Signet one, it was 50-50. Oh, that's bad. 50-50 win-loss ratio. Now here it's an 80% win ratio, but we had those two that crushed us there. Our Fear and Stone Cold. Okay, so the success rate's there, but there's a loss because it's two giant moves, and we would have managed those unless they were overnight drops. Okay, so with all that assessment, even though you have a 50-50 win-loss ratio, you're looking at 5 trades as opposed to 25 in that case. But let me see, because that's designed to be shorter term, not trying to cheat here. Let's run the monthly. That I did do that. That's right. I ran the monthly. My apologies. And we moved it back from May to April. And I should see Altesian, Innovative, Autohome, Acacia Communications, CSX Corp. This was the list we originally did. We took the monthlies and moved it backwards, okay? And this is for naked puts. Okay, this was for the naked puts here. And now let's see if we can get the group results. So the weeklies extended didn't work, and I'd expect that because that's designed to only look for 4 or 5 day out trades, not to extend it to 14 to 17 days. However, short, all right, that's not going to work. Okay, but hey, we can say that Rob's high implied volatility search for 17 days out in time, run on April 1st, did technically outperform extending our weekly naked put search. Although the win ratio was 80% on the weekly naked puts and the high IV we created was 50-50, the loss was only minus 0.2% over 4 trades as opposed to minus, what was that? 1.5%, my apologies, over that same time period for extending the weekly naked put search, which we wouldn't want to do. I'd want to shorten the monthly rather than extend the weekly. Okay. It's interesting that this one's not working. I got to figure that out. I want to see how these perform. And I'm going to run some other performances for you too, Rob. I've got that marked down as well. And I've also got the idea of Fernando's married put all portfolio. And I'm not going to get to a lot of that this weekend, unfortunately, due to other events, as I mentioned. Binh, you said selling an out-of-the-money put spread. I'm sorry, Binh. I'm sorry. Binh's going back to the married put concept. Let's just take this one again. Am I already there? I'm sorry. Let's go to the profit and loss chart. No, okay, I moved it. Okay, let's go to the profit and loss chart here. Okay. And this is for the new position. Now, Binh asked me about one of the 12 income methods, which is doing an out-of-the-money bear call spread nested in the married put. It's essentially a riskless spread trade which leaves the upside open. It's just like selling a call to create a collar, but you add an extra call that leaves the upside open. It's income method number 6 in the blueprint. But Binh says, is it also a good idea to maybe use an out-of-the-money bull put spread? Now again, why would I be opening a married put on Acacia? It's because I'm bullish on the stock. I think it's going to move up in price. I've got myself a low-cost, low-risk insurance. It's out of 260 days. Okay? 270? 260 days, yeah. Okay. Binh says, what about an out-of-the-money bull put? That's not one of the preferred income methods. It's not one of the income methods taught in the blueprint. Why? Well, yes, I'm bullish on the stock. Yes, I think it's going to move up. But if I'm wrong, and right now the 50-55 for a net credit, we're going to hope 37 cents or so at midpoint, 33 cents at midpoint. Sell the 55 by the 50. Okay, we get 30 cents of net credit. That's going to lower my risk. Oh, no, it didn't. It increased the risk. Why? See, when I do the bear call spread against this married put, here's my married put structure. When I do the bear call spread against it, it's really a covered call or a collar with an extra long call, meaning that I don't have to put up the margin requirement for the bear call spread because it's covered by owning the stock. So no extra monetary amount is needed. In the bull put spread, how does the risk go up to 14.2%? Because if the stock falls, I'm losing slightly on the married put and I'm losing on the bull put. This put does not cover this one. I still have to put up the margin requirement, whereas using income method number 6, I do not. And again, you saw it when I open a married put right away. You know, this Acacia here is trading right around 60. Not even, it's at 59. And in order to go out of the money, I've got to go to that 55-50 strike. And if I try to keep it shorter term, well, the premium is almost not worth it. It's 30 cents. It might not be worth it for that extra risk of 5 points. Because if I'm wrong and the stock falls to, let's say, 53, I'm going to add to my risk by having to buy this back for 2 points. Or take assignment and now manage this put to have 2 puts plus the 200 shares. You know? So that's why we don't use the bull put, because it increases the risk to the downside if we're wrong. Now, yes, so it was close to last year when we did this. It was close to 70% of the time, 78% of the time. The stocks I selected did move up my desired 3 to 6% in the first 20 to 40 days. The other 20% of the time, about 3 trades, it moved down. So had I done this, I would have added additional risk. And my performance would not have been as good because I would have had to manage the bull put on those 3 or 4 trades where the stock went against me in the first 20 to 30 days. And I would have had to allocate an additional 2, 2.5, 5 points of margin requirement on each of my other trades to enter the bull put because the margin isn't covered as it is with income method number 6 because of the rights and obligations of the different options involved in the spread itself. All right, Binh, so that's why I don't use a bull put, even though I'm bullish on the position when I first open a married put or if the stock's going as I desire. That being said, there is discussion on using a bull put in conjunction with the married put position. That's income method number 8A and 8B listed in the blueprint there for the married put structure. Okay, so the blueprint I'm talking about here, it gives you the full structure of the married put structure, what we look for, how to set it up, the risk Mark had mentioned, and then the 12 different income methods that we use to lower that initial at risk and potentially bulletproof the trade. That means we've canceled all of the risk. And then there's a chapter on combining income methods and more as well. All right, so that's what we're talking about with the married put in the blueprint. Income method number 8A and 8B, Binh, that might be something you'd want to check out in your blueprint. Related to the bull puts and that certain spread, but preferably I won't use a bull put by itself because of the added risk, where the income method number 6, the bear call inside the structure, does not require any margin and it leaves the upside completely open. Well, the bull put did too, but it just took on too much risk to the downside for my likings. All right. Okay, I'm going to wait. I'm going to encourage anyone, if you have any last-minute questions, to send me to them. I know we're at 5:51, as I mentioned. I'll have no problem staying on extra to make sure all questions are handled. History, it was an error with doing the history, which shouldn't have occurred. Well, it occurred. It's an error. I've stumbled over myself 3 times in it. The programmer told me that the whole history update for today's end-of-day data is almost done. So we can run that comparison now. We mentioned that... extending, let's do this while we're waiting. Okay, let's go back one. Select date, April 1st again. And let's just use the weekly for 4 days out. Let's see if we can get this done. So I think we already did this. Now remember, the numbers I gave you, we were down an 80% success rate and down 1.5%. I think that was taking the weekly naked put search and extending it an additional 10 days. So it was 17 days out in time instead of 4 to the standard expiration, which we used for Rob's, the high IV search we created for Rob. Let's see if we can get the result. Sorry. Okay. So in any case, we'll just hesitate here for a little bit. If you have any last minute questions, go ahead and send those in. We'll wrap up at about 6 o'clock Eastern time. The programmers did just text me and told me that the history is almost done, where I shouldn't be getting those errors anymore. So we're just waiting for that. So if anyone has a last minute question, go ahead and send those to us as well. Of course, while we're waiting, I might as well just do this here. I hate how that always automatically does that. I just want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. Options do involve risk and may not be suitable for all investors. Remember, you can test out the tools. We saw the search tool today. We looked at the portfolio and looking at the rollout opportunities. Managing positions as well. We talked about the different search criteria. You can set it up any way you want to match your needs in any of the 23 different strategies. We looked at back testing, which has a flaw between 5 and 6 o'clock apparently when we're uploading the full history from the end of day data. But again, if you want to test it out for 14 days, no credit cards needed. Just go to PowerOp.com, put in your first name, last name, and email address, and you'll have full use of the tools with the 3-month limited access to those historical tools, which don't only contain the search. You also have the historical search by symbol in any strategy and the historical option chains. So you can scroll back day by day to see the changes in the various strikes, different expiration dates as well with the historical tools. Now our subscription rates start at $40 per month. That's just for the end of day data. The delayed service, the most popular subscription service, is only $60 per month. Taking the 20-minute delayed data and upgrading to full access to the history, which goes back to April of 2006, over 12 years, now 13 years of options data, end of day data. You can upgrade to that to just $100 per month, just $40 more, still gives you everything on delayed plus full access. And of course, we do offer a real-time service, and the premium service includes everything. Now, earlier I shared with you the link to the webinars page. That's a public page, but some webinars may only be viewable for PowerOptions subscribers, but you'll still see a lot of webinars there as well if you just go to it without logging in. You can also see some other information on our blog as well, blog.powerop.com. There's a good reference there I got to point out, and you can always check us out on YouTube as well. All right, so all that being said, let me navigate back over one more time. I want to show you guys one more thing related to our discussions today. And the discussions today, of course, revolved around, some of the discussions today revolved around, can you talk about the pros and cons, essentially, of an all married put portfolio? There is a blog article here. So if you go to the blog, of course, we have a lot of different blogs here. Oh, not there. But what you can search for is called barbell. This should come up. Okay, it did not come. It's old, but it's called A Balanced Approach for Portfolio Success. This blog from April 2nd, 2015 takes the idea of a barbell approach to a portfolio, where some will discuss 90% are in conservative trades, treasury bills, and 10% are in speculative, high-risk, high-reward positions. So the idea here is that rather than keep 90% in conservative trades and treasury bills, you could easily construct a portfolio and have no fear of much risk if 90% of that portfolio is in the married put positions and you keep 10% aside maybe for some bull put credit spreads here and there. maybe strangles or straddles around earnings, sort of a lottery ticket. Buy a couple contracts of a straddle or strangle, big stock with earnings coming up. Let's see if we get a 5 or 6% move and you get a high profit. Or maybe even something just on buying calls on stocks that you've heard a friend mention or a family member mention as well. So this is actually pretty much how our earnings portfolio is designed, believe it or not. He's pretty much close to this 80 to 90% in married puts, doing straddles and strangles around earnings, some other covered calls on long-term holdings he's had for years in other positions. But essentially that's it. I'm younger. I'm in my 40s. I'm a little bit more risky, so I'm just 50% married puts with still having success with 15 to 20% in the bull puts, 10% really right now in diagonals more or less, and 5% or so in those straddles and strangles around earnings, and occasionally, most of the time, 2 to 3% of the portfolio is in portfolio hedges, such as VIX calls. Why? Because in a sudden event, such as February 5th through 9th, 2018, March 21st through April 5th, 2018, October 5th to October 20th, 2018, when these strategies get wiped out because that sudden market decline, the VIX calls gap up and help me hedge the losses I'm taking on that other portion of my portfolio. In fact, in February 5th through 9th, I lost on all three of my bull puts. I rolled one out further in time that ended up being a profit, but I took close to a 70 to 80% loss on the remaining two. But the gains I made in my VIX calls I had open at that time more than countered the monetary loss in the bull put spreads. So it did exceptionally well as an overall portfolio hedge in that structure. Okay, but I'm sorry where I was going with that. That's the blog article you might want to take a look at. John, Fernando also commented on that, and I'm sorry I meant to copy that for you folks. Come on, guys. Come on, computer. There we go. And I'll send that to you in the chat window there. Okay, so you guys can take a look at that at any time. But again, you can just go right to the blog and enter that search text for barbell, a balanced approach for portfolio success. And this will give you some insight into that ideas of putting a larger portion of your portfolio into the limited risk married put strategy while still being able to play actively in the market and not taking on exceptional risk as well. Okay. One last time, let's try it, and then we'll wrap up here. So naked puts. Back test. I'm sorry, I kept leaving the window. Smart history. April 1st. Monthly picks of the day. The search results come up. We're going to shorten it to April. Altesian, Innovative, Autohome, Acacia, CSX. Right. Okay. Rob, everyone, I'll get that information for you next week when we post this webinar, okay? Monday, you'll have that information. We'll also talk more about some of the other things, okay? Ladies and gentlemen, one last time. Let's, no. Oh, good. There we go. I want to thank you for joining me today, and thank you all for your excellent questions. Remember, if you think of any questions later on, send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call the office during market hours at 302-992-7971. And remember, trial members and subscribers, you can schedule a coaching session at any time. Take care, everyone. Have a fantastic weekend. I'll update that naked put screen for you, those naked put results. We'll run the comparison also over extended time now that I have it saved. And for Fernando as well, give you guys the insight on what a all married put portfolio would have looked like compared to a different portfolio. Let's just take over the last 3 months in a good bullish run. Thank you again, everyone. Take care. We'll see you soon. Good night.